Imagine waking up one morning and finding that the Federal Reserve has completely changed the direction of U.S. monetary policy. The dollar drops, Treasury yields fall, gold jumps toward $5,000, and silver suddenly starts racing towards $70. Now imagine the opposite. Inflation refuses to cool, oil prices surge, the Fed turns hawkish, and the September meeting brings a rate hike that almost nobody expected. That is the decision traders are preparing for right now. And here's the important part. The market has already started changing its expectations. As of August 17th, the probability of a September Fed hike had fallen to roughly 30.31%, down dramatically from around 50% a month earlier. Gold was trading near $4,399 and silver around $65.61. But don't make the mistake of thinking this automatically means a rate cut is coming. That is not what the current data says. In fact, the most important possibility for September may be neither a cut nor a hike, but another hold. A Reuters poll conducted August 12, 17 found that a strong majority of economists expected the Fed to keep rates at 3.50% to 3.75% through the end of 2026. Only a minority expected another hike, while even fewer expected cuts. So why are traders suddenly talking about gold at $5,000 and silver at $70? The answer is more complicated than simply saying rate cuts are bullish. Let's start with what the Federal Reserve actually did at its most recent meeting. On July 29th, the FOMC left the federal funds target range unchanged at 3.50% to 3.75%, but the vote was far from unanimous. The decision passed 9-3, meaning 3 policymakers preferred a rate increase. That matters because it showed that a meaningful hawkish faction still existed inside the Fed even before the latest economic data arrived. The September meeting, therefore, isn't starting from a completely neutral position. The Fed already knows that some officials believe inflation remains too high and that additional tightening could still be necessary. Now comes the first major piece of new information. The labor market weakened sharply in July. The U.S. economy unexpectedly lost 23,000 non-farm jobs, while economists had expected an increase of about 80,000. Even more importantly, previous May and June payroll figures were revised downward by a combined 103,000. The unemployment rate technically improved from 4.2% to 4.1%, but that headline number needs context. The labor force participation rate fell to 61.4%, with about 264,000 people leaving the labor force. Wage growth also slowed to 3.2% year over year. Why does that matter for gold? Because the Federal Reserve has 2 major responsibilities: price stability and maximum employment. If inflation remains elevated while employment is strong, the Fed can justify keeping rates high or even raising them. But if inflation is cooling while employment is losing momentum, the argument for additional tightening becomes much weaker. This is exactly the combination traders are watching right now. The July jobs report didn't prove that the economy is collapsing, but it did make the Fed's path toward another hike considerably harder to justify. Then came the inflation data. July CPI increased just 0.1% month over month, matching expectations. Annual CPI was 3.4%, down from 3.5% in June. Core CPI, which excludes food and energy, rose 0.2% on the month and was up 2.5% annually. That is still above the Fed's 2% inflation objective, so calling this a victory over inflation would be premature. But the direction matters. Inflation isn't accelerating across the board, and that gives policymakers more room to wait instead of immediately tightening again. There is another inflation signal that traders shouldn't ignore. Producer prices were unchanged in July. That was another piece of evidence suggesting that broad price pressures were not suddenly exploding. It doesn't mean inflation risk has disappeared, especially with energy prices affected by geopolitical tensions. But when you put the producer price data alongside the July CPI and weaker employment figures, the story becomes more balanced. The Fed now has less reason to panic about inflation than it had earlier in the summer. And then the consumer delivered another warning sign. U.S. retail sales fell 0.6% in July, the first monthly decline in 9 months. Core retail sales also fell 0.4%, surprising economists who had expected an increase. Consumer sentiment deteriorated in August after improving for 2 consecutive months. This is important because interest rates don't only affect inflation, they also affect borrowing costs, housing, business investment, and consumer spending. If consumption begins losing momentum, keeping monetary policy restrictive becomes a more complicated decision. But here is where the story gets interesting for gold and silver. A weaker economy alone doesn't guarantee higher precious metal prices. What matters is how financial markets interpret the Fed's reaction function. If weaker data causes Treasury yields to fall and the dollar to weaken, because investors expect less restrictive monetary policy, gold can benefit. That is exactly what we've recently seen. On August 17th, gold climbed to around $4,398.58, while the dollar index fell about 0.2%. Silver also gained 1.5% to around $65.61. Now let's talk about the $5,000 gold target carefully. A target is not a guarantee. Gold reaching $5,000 would require another substantial move from current levels, and several variables would have to cooperate. Lower real yields, a weaker dollar, stronger investment demand, continued central bank buying, geopolitical uncertainty, and expectations for easier monetary policy could all contribute. But if inflation remains stubbornly high and Treasury yields rise sharply, gold could face resistance instead. So the intelligent question isn't, will gold hit $5,000? The better question is, what economic conditions would make $5,000 more probable? For gold, one of the biggest variables to watch is the relationship between interest rates and real yields. Gold doesn't pay interest or dividends. When investors can earn attractive inflation-adjusted returns from safe bonds, the opportunity cost of holding gold rises. But when real yields fall, that disadvantage becomes smaller. This is why a dovish Fed can be supportive for gold even before an actual rate cut occurs. Markets price expectations in advance. If investors believe monetary policy is becoming less restrictive, bond yields and the dollar can react before the Fed actually changes the policy rate. And this brings us to one of the biggest misunderstandings surrounding September. A Fed hold can still be bullish for gold. Imagine the Fed keeps rates unchanged, but signals that another hike is unlikely unless inflation reaccelerates. Markets could interpret that as a dovish hold. Treasury yields could fall, the dollar could weaken, and gold could rise. On the other hand, the Fed could hold rates, but strongly warn that another hike remains possible. That would be a hawkish hold, and gold could react very differently. The headline decision alone isn't enough. The language matters. Now let's move to silver, because silver's story is not identical to gold's. Silver is both a precious metal and an industrial commodity. That means it responds not only to monetary policy and investment demand, but also to industrial activity. This creates both an opportunity and a risk. If lower rates support economic activity and investor demand while physical supply remains constrained, silver could outperform gold. But if the economy weakens too aggressively, industrial demand could become a headwind. That's why a $70 silver target requires more than simply predicting a Fed cut. At around $65.61, silver is already relatively close to the $70 level discussed by traders. A move from $65.61 to $70 would be roughly a 6.7% increase. That's significant, but it is not an impossible move for silver given its historical volatility. The bigger question is whether momentum can hold above important technical areas after the initial breakout. If silver approaches $70 during a period of falling yields and a weaker dollar, buyers may remain aggressive. But if it reaches $70 while the dollar and yields are simultaneously rising, the move could become much harder to sustain. There is also a major external risk that could completely change the Fed's calculation: oil prices and geopolitics. The ongoing U.S.-Iran conflict has pushed oil prices significantly higher, and Reuters reported that oil prices had risen about 25% during the 6-month conflict. Higher energy prices can create a difficult situation for the Fed because they can push inflation higher while simultaneously hurting consumers. That creates the worst combination for monetary policy. Inflation remains elevated while economic growth weakens. So what could actually trigger the surprise hike mentioned in our title? The first possibility is a renewed inflation acceleration. If upcoming inflation data suddenly shows stronger price pressure, especially in core categories, policymakers could become more concerned. The second is a rebound in the labor market. If the next jobs report dramatically reverses July's weakness, the argument that the economy is slowing could disappear quickly. The third is a sustained rise in energy prices. And the fourth is a combination of all three. That's the scenario gold and silver traders should not ignore. But there's an equally important scenario on the other side. Suppose inflation continues to moderate, the labor market remains soft, consumer spending stays weak, and the dollar continues falling. In that environment, the Fed could find it increasingly difficult to justify additional tightening. Even if it doesn't cut in September, markets could begin pricing a greater probability of easing later. And that is where gold's $5,000 narrative becomes much more credible, not because the Fed announces a magical gold target, but because financial conditions begin moving in a direction that historically supports non-yielding assets. The next major clue is the July FOMC minutes. The minutes are scheduled to provide more detail on how policymakers viewed inflation, employment, and the balance of risks at the July meeting. Investors will be looking especially closely at the disagreement behind that 9,3 vote. The September meeting itself is scheduled for September 15th, 16th, 2026, so there is still a significant amount of economic data between now and then. And this is exactly why I would not make an investment decision based solely on today's Fed probability. CME FedWatch probabilities are market-implied expectations derived from 30-day Fed funds futures. They are useful, but they are not promises from the Federal Reserve. A probability can move dramatically after one inflation report, one jobs report, or one major geopolitical event. So if you're positioning around September, watch the direction of the probabilities, not just one snapshot. For gold traders, I would watch 4 things together: the US dollar, Treasury yields, inflation data, and labor market data. If the dollar weakens while yields decline and inflation remains controlled, that combination would generally create a more favorable environment for gold. If yields rise and the dollar strengthens because markets become convinced of another hike, gold could struggle even if geopolitical uncertainty remains high. This is much more useful than simply saying Fed cuts equal gold up. For silver, add a 5th variable: industrial demand. If monetary conditions become easier while economic activity remains healthy, silver gets a potential double benefit: investment demand plus industrial demand. But if the Fed becomes dovish because the economy is deteriorating rapidly, silver's reaction could be more complicated than gold's. That's why silver at $70 isn't simply a smaller version of the gold $5,000 story. They have different drivers. So where does that leave us right now? As of August 17th, the market is clearly moving away from the idea of an imminent September hike. Gold is near $4,400, silver is above $65, and the dollar has weakened as traders reassess Fed policy. But the broader economist consensus still leans toward rates staying at 3.50%, 3.75%, not an immediate cutting cycle. And here's the most important takeaway: September isn't really about guessing one number. It's about identifying which economic story wins. If inflation wins, the Fed stays hawkish. If employment and consumer weakness win, the Fed becomes more cautious. If both inflation and growth weaken together, the conversation can shift rapidly toward easing. And if geopolitical energy shocks push inflation higher while growth slows, we could see an extremely difficult policy environment. So could gold eventually reach $5,000? Yes, it is a plausible scenario, but it requires a favorable combination of monetary, currency, and macroeconomic conditions. Could silver reach $70? At around $65.61, that target is considerably closer, but it still depends on momentum, industrial demand, and the broader precious metals environment. Neither target should be treated as guaranteed, and neither should be used as a reason to blindly buy at current prices. The smartest approach is to build scenarios rather than predictions. Scenario 1. The Fed holds and sounds hawkish, gold and silver could face pressure. Scenario 2. The Fed holds but becomes clearly less hawkish, precious metals could gain. Scenario 3. The Fed eventually cuts because growth and employment weaken. Gold could receive a stronger monetary policy tailwind, while silver's performance would depend on whether industrial demand holds up. And Scenario 4. Inflation surges again and forces another hike. This could create the biggest short-term shock for both metals. That is why the next few weeks could be more important than the September announcement itself. Watch the upcoming inflation numbers, labor market data, consumer spending, oil prices, Treasury yields, the dollar, and the Fed's own language. Those indicators will tell you whether the $5,000 gold story is becoming stronger or whether traders are getting ahead of themselves. And remember this: the market usually moves before the headline. By the time the Fed officially announces its decision on September 16th, a large part of the move could already have happened. The real opportunity and the real risk is in understanding what traders are pricing before the announcement. So don't ask only, will the Fed cut or hike? Ask the bigger question: what will the Fed be forced to do if inflation, jobs, spending, and oil prices continue moving in opposite directions? because that answer could determine whether gold makes its next major move toward $5,000, whether silver finally challenges $70, or whether both metals face another sharp correction first. This video is for educational and informational purposes only and should not be considered financial, investment, or legal advice. Always do your own research, understand your risk tolerance, and consider speaking with a qualified financial professional before making investment decisions. The September Fed decision is still weeks away, but the market is already voting with its money. The question is, are you watching the right signals?